You are listening to chartingwealth.com for Monday, the 22nd of February, 2016. The year is underway, continues to move along whether we like it or not. Where did the markets end up and where are they going this next week? Well, let's start with what we know. The market started moving up, crossed over on the 16th of February. Two strong green open box candles, which means lots of up movement. Then what we saw happen on the last candle that's been drawn, and again, it's just the first day of that last two-day candle. It'll complete itself on Monday the 22nd, but it is a red open box, and it's still above the two-day trend line, really just sitting on it on IYY, which is the total market index fund. It tracks the entire market. If we drop back from that two-day chart and look at our 4-hour chart, what do we see happening? Well, the market's really just been sliding sideways. It hit its peak back on the afternoon of Wednesday, the 17th of February, and it really has not gone above that since then. It's just slid sideways pretty much. Technically, the market was down 0.03%. What is that? That's 0.03%. So what did it do? It basically held steady. Got a little bit of a green box. It ended in the afternoon on Friday. What does that mean? Not much of anything. Market's just sliding sideways, still above the two-day trend line, still in a confirmed up move on the big chart and the smaller 4-day chart. Derivative oscillator's been losing some speed, but I would say a little bit more of a convergence, but nowhere near a crossing yet on the 4-hour chart. Now again, what are we looking for? We'd love to see the 4-hour chart crossover going down like it did back on the 5th, and then move back into a position that tracks the up move. So we've got a good safe area to enter on the chart, the big chart that's already moving up. That's what we like to try to do. We like to try to trend follow because we've got the big chart in an up move at this point. So we wait for a backup on the small chart, and then when the small chart has moved down and then crosses back over going up, bam, that's when we look to get in. And when we see things like that happen, as we saw happen in the big chart on the last move down, that's where we look to plug in and ride it out and make some money. Now, let's go from here on the 2-day chart. We're going to now go to SPY. What is that? That's the Standard & Poor 500. It also is in a confirmed up move starting back on the 16th of February. We've got a red box at the end of the first day of the 2-day candle on the 19th Friday, still above the 2-day trend line. And for those of you who don't know how to draw trend lines, very easy to do with free stock charts. You always draw a trend line bottom up. So when the stock is the commodity stock index, whatever it is moving up, you draw it at the bottom. You try to connect at least 3 candles to really have a trend line that you can count on, that you feel like you can count on. Not that they always stay, but if I had only one thing I could do, you gave me no indicators and you said, figure out where stocks are going, indexes, whatever, I would use a trend line first and foremost. When that trend line is broken, many times the stock, the commodity, the index is going to move in the opposite direction. That'd be better than nothing. But we have the MACD and the derivative oscillator that we also use. Sometimes folks say, why can't we use more indicators? You can. You can use 100. What will happen? You will get analysis paralysis, and we stay away from that. We would rather make moves and figure out what's going on from a smaller number of indicators, because it's so much easier to make a decision. And I'm telling you, making a decision is important. Now, if you sit around and you engage in analysis paralysis, you'll never do anything, or the moves you make will be way too late. So that's why we're looking to trend follow. That's why we're looking for a backup on the short chart to then wait for it to turn back around and parallel the movement on the big chart and to hop in. So we see what's going on in the Standard & Poor 500 up move. If we back down to the 4-hour chart, what happened intraday, pretty much just a sliding sideways. The S&P 500 was down 5/100ths of a percent. So again, pretty much a sideways slide. Again, S&P 500 topped out in the afternoon back on the 17th and has just been sliding sideways since then. We don't have a crossover going down yet, although it is converging, appears to be, in the derivative oscillators losing speed. Now, let's jump back to our 2-day chart. And we're going to check out the Qs, which was technically up 0.3% for the day. It also ended the first day of the 2-day candle on Friday the 19th with a red down box. Movement was never above where the market opened yesterday. When I say yesterday, I'm recording this on Friday on the 18th. Thursday, we still have it crossed over going up on the candle on the 18th. So we haven't had much of a track going up as far as the Qs, which is, of course, the NASDAQ 100, our tech stock index. We do have the derivative oscillator continuing to gain speed and get bigger. Now, if we drop back and see what happened intraday, we see again, like the others on the 18th, well, actually, yeah, even on it hasn't really gone much above where it peaked out on the 17th of February, and the market's actually slidden sideways, and pretty much. I mean, it has gone down some, but it's pretty much just slid sideways. Not yet a crossover, but the derivative oscillator is losing steam, so we'll see if there's going to be a backup. Now, when it backs up, it doesn't mean we get into a down move, of course. We're waiting for it to move down and then start moving back up again. If it doesn't violate the 2-day trend line, even better, means that that up move is probably going to be even stronger and better for us. If it does violate the 2-day trend line, we'll be much more cautious if it does rotate back over to go up. We'll just wait and see. That's what we do. We are not traders on Wall Street that have to trade. We want to trade and invest when it makes sense for us. Otherwise, you keep your money safe. Now remember, we don't give you any advice on real trades. Everything we talk about here are for you to open your own virtual account at a online brokerage firm, and then you can practice. Once you practice, remember, perfect practice makes perfect. Once you get it down, you can read a chart, you can enter a trade, an investment, make money time after time, then you can make up your own mind. We are not engaged by anyone to give trading advice. We are simply about education. Okay, enough said there. Let's go back to our 2-day chart, excuse me, and jump over to gold. Gold up down 0.6% for the day. Gold has broken through the 2-day trend line, even though it was an up candle. Again, that's the first candle drawn in the it's the first half of the 2-day candle drawn on the 19th. That candle will finish itself out on the 22nd, Monday. But what do we see going on if we drop back intraday and take a look? We see that it did not close below. Actually, it slid sideways. Gold has continued to slide sideways, crossed over on the 4-hour chart going down. Now, if indeed gold crosses back over going up and the 2-day chart continues in an up move, then of course that would be another possibility for you to wait for that pullback and then continued up movement if it's going to do it. But if you look at gold, it hasn't gotten anywhere close to its high on the 12th of February, much below that. So a lot of that initial energy, as shown by the derivative oscillator, has peaked. And we see the MACD, the moving average convergence divergence line, and the signal line getting closer together. So be careful in gold. Our 4-hour chart can be a decision trading chart in gold. It has been in the past for us, and it, of course, is in a confirmed down move right now. So be very careful. If you are long, what does long mean? That means you're expecting gold to go up. Just be very careful if you've not already gotten yourself out of your virtual trade in gold back on the 11th or 12th. Well, I guess say, yeah, around the 11th, maybe the 12th, even if you stayed in. Hopefully you didn't stay in past that. You took your money and you are happy with your virtual account being considerably larger. Folks, that's where we have ended the day on Friday as we go into a new trading week. If you've not already heard our weekly review and forecast, you need it. So make sure that you listen to that. It's the one time every week that we review what happened in the prior week, what we see coming up in the next week, and the news events that might have moved the market and what might be moving the market in the next trading week. Thank you so much for listening. We appreciate you being with us. If you're not signed up for our newsletter, go ahead and do it. You'll get this podcast every day along with how to read a stock chart, a link to our wonderful video, along with our layout from freestockcharts.com. Thanks so much from chartingwealth.com.